Trade like the dead. Trade like the dead. All right. I like the title. I kind of give away the ending, don't I? A 10-year study completed in 2013 found that the best individual investors, the individual investors with the highest rate of return, were who? Was it you? Was it me? Was it the crypto bros? No. No, I gave it away already, right? There I'm circling the blank spot where the word dead drops in. Dead people. Dead people had the best individual investor trading results. Why? Or individual investor returns. Why? Because their estates go into probate and they don't trade, right? It's the same reason that a lot of foreclosures in Canada are actually people who've passed on, because that's who also doesn't make mortgage payments. You know what else they do? They don't churn. They don't buy, sell, buy, sell, buy, sell. They just buy and hold. So that's a pretty big tip, right? Trade like the dead. So can you play dead? That's the key question. Can you play dead and try and trade like the dead, which is just, start small, stay smart, open that TFSA. I think it's really interesting the way the TFSA annual contribution limit almost mirrors CPP. It's pretty close. It's pretty close. And so I think by design, this works very nicely with what I am talking about, right? Buy that Vanguard S&P 500 index fund, first of the month, every month, 12 units per year, inside your TFSA, and, eat, drink, and be merry. It's just going to build itself slowly inside your TFSA. Now, if you'd put it all into WWE stock, would have done a whole lot better, right? Sunday, Sunday, Sunday. That's the tractor pull voice, I think. Anyway, yeah, okay, so the Standard & Poor's Index certainly got crushed by WWE, but hey, picking one stock, well, don't worry, that slide's coming up. Some of you remember last year, I had that great stock tip. Still sitting on it, and we'll talk about that. Oh, I can't believe I'm going to share this with you guys. All right, so 2021, my S&P 500 units had dropped significantly because I just temporarily pulled some out of there because I got this great tip. So I was just going to pull it out and put it over here just briefly, make some nice money, and then pull it back in and then come back and replace my Vanguard S&P 500 shares. I have done a reasonable job of replacing and catching up, so I'm sitting at 30 units inside my TFSA. But as you can see, the market value of that is far cry from my total TSA contribution room. The 2021 dumb move was buying 10,000 shares of this stock at $5 a share, which had then fallen to $1.27. So that was a $37,000 oops. With a market value then of $12.7. I could have got out. I could have got $12.7 out. But here's why it is the extra dumbest move I've made. I bought a flyer. I bought a hot tip in my TFSA. Why would you do that? Because if it goes sideways, if it goes the other direction, and you can see where this story is going, there's no tax offset. I don't get the benefit of a tax loss. So if I sold this, I wouldn't even get the benefit of, if I'm in a 25% tax bracket and I sold at a $40,000 loss, at least it would save me 10 grand in tax. That would feel like I was getting something back. But no, I bought it inside my TFSA where there's no taxable loss allowed. So dumb. But wait, there's more.
But wait, there's more.
Averaging down on dumb. So I had another one that I pivoted out of. I sold a chunk of the SLHG, pivoted into another one that shot up. Of course, I should have sold it all and pivoted into the other one, but I didn't. It shot up, I cashed out, and then I thought, wow, it's down to 60 cents a share. 60 cents a share. I can bring my average price down to $2.50 from $5. I'm going to buy another 15,000 shares. I'm going to put another $9,000 in because, hey, in for a penny, in for a pound. Let's do it. And then over the last 12 months, it subsequently fell to 30 cents. So that was another 4,500 I've burned. And now you can see I'm sitting at a $56,000 hit. This is why I'm not playing the stock market. It's why I'm not. What do I advise? What do I ever advise any of you guys? I just advise you to buy the S&P 500 index fund. Why am I sharing this horrific, painful experience that makes me look quite stupid? So that you know that some of you, you're not alone, because you've done it too. You're not alone. It's okay. But also, for others of you, to scare you away from the hot tip, and also to make it clear that you don't do this inside your TFSA. TFSA is slow and steady, baby. Slow and steady, and historically, pretty much the safest plays you can make. So yeah, that was a little bit of a painful experience. And as I say, the hard lesson there is the tax-free savings account is meant for what? It's meant for long-term holds, not short-term, high-risk plays. That was just dumb because, yeah, there's no tax on gains, but there's no tax deduction on your losses. And that's why we'll hang on to that until it either goes to zero or bounces back at some point. I'm just, as I say, I'm riding that baby out now. So last year I shared with you this horrific looking, 32 grand loss inside my TFSA, looking like a dumbass. Now it's 57 grand. I can't wait till next year. I mean, there's really not much room for it to go any lower at this point. There's only about 7,500 more worth of room. So, lessons learned. And yeah, we all learn these lessons, but I don't want you to learn this one the hard way yourself. Learn from my mistake. Start small, stay small, be disciplined, stay disciplined. If the only equity play you have in your life is the Vanguard S&P, that's a great move. I mean, I have branched out a little bit, but what have I branched out into? Canadian bank stocks that I'm buying at like a 52-week low that pay me a nice dividend. That's it. And I'm just trickling it in on a monthly basis, dollar cost averaging. Dollar cost averaging. That's one thing at least I've really, really learned.